Advanced Accounting 17A Intercompany Transfers of Land. This is Ken Boyd, the owner of Singlet's Test Preparation. Here's our Facebook page, and the reference for this video is the Advanced Accounting text by these authors in Chapter 7. So what we're talking about here is intercompany, and indicating that there is a parent and a subsidiary within the same company doing the transaction. So let's talk first about, well, what would be a typical land sale for a gain? For example, simple example, land is sold for $10,000 and the seller's cost is $7,000. We have the buyer's books and we have the seller's books. If you're the buyer, you put the land on your books, you increase by debiting an asset account called land, and the asset's valued at your cost, which is $10,000. And you'd credit cash or to reduce it, or create a payable for $10,000 by crediting. The seller is going to receive the cash of $10,000 by debiting, increasing an asset. They are going to credit to reduce the land account, which was the asset they sold, credit $7,000 at their cost, which we found out was $7,000. And in order to make debits equal credits, we need a $3,000 credit to make debits and credits balance. We call that gain on sale. Had it been a debit to make the entries balance, it would be a loss on sale. So that's a typical land sale. Now, if that was an intercompany transaction, there would be a few problems. First of all, the buyer would have land, there's the buyer, would have land that would be overstated by $3,000 because their cost is $10,000, which really within the same company the cost should stay at $7,000. So land is overstated by $3,000. The other problem, if this gain on sale was intercompany, is that the seller is recording a gain on sale of land, which increases their net income. So their net income in the current year is overstated, and if things aren't corrected in future years, their retained earnings will be also overstated. So that's a gain. Let's look at a typical land sale for a loss. Buyer buys, let's say the land is sold for $5,000, the cost to the seller remains the same at $7,000. So buyer increases an asset account called land by debiting, $5,000 debit, the asset is valued at his cost, $5,000. He pays cash or has a payable. The seller gets cash in the door of $5,000. They're taking an asset off the books, land, by crediting $7,000, which was the seller's cost. In order to make debits equal credits, we need a debit entry of $2,000, which means that the seller has a loss on sale of $2,000. So there's a problem with this issue too, with these transactions. First of all, the land on the buyer's books is understated by $2,000. It should, within the same company, remain at a $7,000 cost. Instead, the buyer debits land to increase it for $5,000. The other thing is that the seller has created a loss on sale incorrectly if it's intercompany. Net income is understated in the current year for the seller because of the loss. And in future years, if nothing is corrected, retained earnings is understated by $2,000. So now let's move to our more comprehensive example, intercompany. This is an intercompany upstream, which means sub sells to parent. This parent is going to be the buyer. Upstream, up to parent. Downstream would be a sale down to the sub. Upstream sale to the parent for a loss. And let's further assume in 2002, our starting point, that the parent purchases land from the subsidiary, and the parent owns the 70% of the subsidiary for $125,000. The sub's cost of the land is $80,000. One thing that's difficult, I find, for people in these transactions, understanding the non-controlling interest. So on the buyer's books, who's the parent, we have a parent and a non-controlling interest. We have really two buyers. In total, we buy the land and put it on our books at our cost of $125,000 debit, and we pay $125,000 cash. We credit to reduce cash. Now, we can take of that $125,000, 70% of it, and that's going to be on the parent's books, debit land, credit cash. 30% of this amount is going to go on the non-controlling interest books. They own the other part of the company, debit land, credit cash. So what's going on if you move further to the right? The parent's land is overstated by 31.5. The non-controlling interest land account is overstated by 13,500. If I add those up, I get $45,000, which is the difference between the cost of the land to the parent 125 and the subsidiary's cost of 80,000. That's what's on the buyer's books, including a parent and a non-controlling interest. On the seller's books, the subsidiary, they're getting cash in the door of 125,000. They're removing an asset called land by crediting at their historical cost of 80,000, and the difference, this gain on sale, $45,000 credit to make debits equal credits in total. The subsidiary's net income is overstated by $45,000. So now the question is, what do I do to correct it? Because in consolidation, I have a note here, we don't want to have the gain or the higher asset value of the land. Neither one, neither the gain nor the higher asset value of the land should be recognized. So in 2002, the year that it occurs, if we were doing elimination entries to consolidate both parent and sub, in total, regardless of whether it was non-controlling interest or parent, we would debit to reduce an account called gain on sale, and I write off to the right here, removes the overstated gain on sale, and we would credit to reduce an account called land, $45,000, which removes the overstated land. That's what we do in the current year. In future years, that gain on sale that was in net income is going to go to retained earnings. So if it was a future year, we debit retained earnings to get rid of that gain, and we would still be crediting land. Okay. And it says in consolidation here, I'm just going to widen this just a bit. There we go. In consolidation, let's move to the year 2004. Let's say that the parent sells the land to a third party. Now note, once we sell it to the outside world, so to speak, a third party, now as a company we're going to record a gain or a loss. So remember that phrase third party, because in that case we would have a gain or a loss because we within the company, parent or sub, no longer own the land. So I say in brown here, in consolidation the gain is recognized and the original cost of the land transfers, regardless of whether that land is in the sub's hands or the parent's hands. So we would debit to increase cash $115,000. We would reduce an asset account called land by crediting $80,000, and in order to make debits equal credits, we need a credit called gain on sale. So in summary, if you were to look at the T accounts, we bought the land in 2002. We had this inflated price of land. It's $45,000 too high, and we had a gain on sale off to the right here that shouldn't be recorded. So our elimination entry in 2002 would be to credit to get rid of the overstatement of the land and debit an account called gain on sale, and those are our debits and credits for the elimination entry. Actually, this is the credit, this is the debit. You'll see transactions down here where we talk about the subsidiary buying the land from the parent, and we'll do that on the next video. That's the end of Advanced Accounting 17A. We now have video textbooks, complete explanations on videos from 30 minutes to an hour of lots of accounting topics. for one-on-one live tutoring. Here's the website where you can get live tutoring information and the video textbook information. Here's our email address and our phone number. Thanks very much, and we'll see you next time.